All right, today we're pulling back the curtain on the conventional loan rulebook. You know, that kind of hidden framework that pretty much runs the show for most home loans in the US. But who actually writes these rules? And more importantly, why do they have such a huge say in what you can buy and what it's going to cost you? Well, let's dive in and find out. So, who's really in charge? I mean, who writes this thing? It's easy to think it's the big banks, right? Or maybe even the government setting all the standards. But the real answer? Well, it's a little more complicated than that. It's not just one group. Turns out, there are two super powerful, kind of behind-the-scenes players who are really setting the stage for the entire mortgage market. And here they are, Fannie Mae and Freddie Mac. You've probably heard the names. They're what's known as government-sponsored enterprises, or GSEs for short. Now, the best way to think about them is like this. They're the giant wholesalers of the mortgage world. So a bank or a lender, they'll make a loan to a home buyer, and then boom, Fannie and Freddie step in and buy that loan from the lender. And that one simple act, buying loans, that is absolutely central to their whole mission. See, their main job is just to keep money flowing through the housing market. By buying up all those loans, they hand the cash right back to the lenders. And what do the lenders do? They turn around and make more loans to more home buyers. It's this big cycle that keeps the whole system moving along, nice and stable. But here's the catch. Fannie and Freddie can't just buy up any old loan that a lender makes. That would be way too risky. To protect themselves, they have to figure out a price for every single loan they buy. And that price is based on one thing: how likely it is that the loan will get paid back. And that price, it directly impacts what a borrower ends up paying for their mortgage. The way they do this is with something called loan level price adjustments, or LLPAs. Just think of these as little fees that get tacked onto a loan depending on how risky it looks. The higher the risk, the higher the LLPAs, which means a higher interest rate or more closing costs for the borrower. It's that direct. And you can see the connection here is crystal clear, right? Got a lower credit score? Yep, that's going to mean higher costs. Putting less money down, which gives you a higher loan to value, you're looking at higher costs. Buying an investment property instead of a place to actually live in, you guessed it, higher costs. The bottom line is really, really simple. The stronger your profile as a borrower, the cheaper your loan is going to be, period. So all this talk about risk pricing brings us right to the borrower's side of things. How much skin in the game do they actually have? Because that is a huge piece of the puzzle, and it all starts with the down payment. For conventional loans, you've basically got a couple of main tiers. Now, there are some really specific programs, like Fannie Mae's Home Ready, that let you get in with as little as 3% down. But these usually have strings attached, like income limits or rules about being a first-time homebuyer. For most people, the more common standard for a conventional loan is going to be 5% down. Okay, but the down payment isn't the only money changing hands here. A lot of times, buyers can get some help with their closing costs straight from the seller. It's called a seller concession, and you probably saw this coming. There are very specific rules for that too. The rule here is actually pretty straightforward. If you, the borrower, put down less than 10%, the seller can kick in up to 3% of the sales price to help with your costs. But if you bring 10% or more to the table, that cap doubles to 6%. So more skin in the game from you unlocks the door for more help from the seller. Makes sense, right? Okay, so we've got all these rules, all these risk factors, all these numbers. How on earth does a lender take all of that and spit out a decision, sometimes in just a few minutes? Well, the answer is automation. This is where the real magic happens. Each of the GSEs has its own super powerful computer brain, an automated underwriting system, or AUS. For Fannie Mae, it's called Desktop Underwriter. We just call it DU. And for Freddie Mac, it's Loan Product Advisor, or LPA. A loan officer just plugs in all of a borrower's info, and these systems crunch the numbers against that entire massive rulebook in an instant. And the result everybody is crossing their fingers for is approve/eligible. This is basically the system's big green light. It means, yep, this loan file checks all the boxes, and we are good to go. It makes the whole process so much faster and smoother. And that is exactly why getting all your information in accurately from the very beginning is so, so important. But not every loan application is going to be that simple. Some types of loans face a much higher bar, a lot more scrutiny from these automated systems. And a perfect example of that is a loan for an investment property. Yeah, the rules for investors are way tighter. You're generally going to need a much bigger down payment, which means a lower LTV. You have to have more cash saved up. We're talking 6 to 12 months worth of mortgage payments sitting in the bank. The credit score requirements are higher, and you absolutely have to prove your rental income with documentation. It's a whole different ballgame. Okay, so let's say the loan gets that approved/eligible from the system. We're in the home stretch, but what happens next? Before you can actually get to the closing table, there are a few final, really critical items that have to get checked off the list. And one of the biggest is hazard insurance. You can't fund a loan without it, and the policy has to meet two requirements that are totally non-negotiable. First, the lender has to be named as the loss payee. That just means if the house burns down, they get their money back. And second, the coverage has to be enough to cover at least the loan amount or the full cost to rebuild the house.
Now for one last really important question. What happens down the road? Say the borrower gets a big bonus, or they want to refinance in a couple of years. Is there some kind of penalty for paying off their conventional loan ahead of schedule?
And the answer is a big, resounding no. Absolutely not. All loans that are backed by Fannie Mae and Freddie Mac are completely forbidden from having any prepayment penalties. And this is a massive, massive benefit, you guys. It gives borrowers the freedom to manage their own debt however they want, without ever getting punished for paying it off early. So look, this rulebook, it's incredibly complex, but it's not just a random set of hurdles. It's a massive system designed to balance risk for everyone involved while keeping the whole housing market afloat. And for anyone in this world, understanding these guidelines isn't just about checking boxes. It's about knowing how the game is played so you can set yourself up for success. Because at the end of the day, these guidelines aren't just rules to follow, they're the tools you use to build a successful loan.